Chapter 6 is actually looking at the allowance side of it. Okay, so chapter 5 is looking at the deductions, right? But remember, both are important from a test structure point of view because this is the format that we use when we approach test questions. Okay, it can be the assignment, it can be the exam, it doesn't matter what it is. When you look at a tax question, you need to identify the requirements. So if the required asks you to work out taxable income, then you need to draw up the structure. You need to address income, which is study unit 4. Okay, study unit 4 spoke about gross income and what determines gross income. And we spoke about the general definition for gross income and what you actually need to consider when including things into that particular, let's say, category. Okay, so you've got different line items here. Under each line, you're going to have separate workings. So this is just the very basic format. Obviously, from an exam point of view or from an assignment point of view, it will be more detailed. Okay, you will see more lines under each of these because under income, then you need to state all the income. You're obviously going to start with gross income, so anything that meets that definition. Then you're going to provide for any exempt income line items. Okay, so exempt income, things that aren't going to be taxable, right? So things that are excluded from this, the taxable income. And you might have to include any special inclusions. So those are the three things that you need to look at. Right, remember, with tax, it's quite a nice subject because everything is very separate. Everything is very standalone in terms of its own legislation, its own rules. Okay, so if I'm specifically looking at income, then I just need to think about content from study unit 4. If I'm looking at deductions, then I'm looking at content from study unit 5. If I'm looking at allowances, then I'm looking at content from study unit 6. So that's what you're going to have to think about when you're going through past papers and questions, either from the assignment or other. You just need to think about approach. So what am I dealing with? What am I asked to calculate? And then which section am I looking at? If I'm looking at deductions, then I need to apply the rules from study unit 5. If I'm looking at allowances, then I need to apply the rules from study unit 6. And that's it. That's the approach. And if you can keep it simple, it's quite easy to approach as long as you don't confuse the different sections. Okay, so every section is very separate in terms of content. It has its own rules to follow, and if you keep it like that, it's quite easy to approach. Okay, you just need to decide. Well, where am I? Am I looking at study unit 4, 5, 6, and then later on, chapter 7? Okay, or study unit 7. Right, the taxable gain. Okay, CGT. That again is a separate consideration. It's covered in a separate study unit. Right, so that's very important. Just to give you some recap, we've looked at income, we've looked at deductions. Now we're looking at this one, allowances. The last one we need to look at in order to get this taxable income is the CGT. Okay, so study unit 6, what is this going to cover? Well, if you look at the learning outcomes, you'll see in this particular chapter, you're looking at an allowance, not a deduction. So an allowance relates to something that is being classified as capital in nature. So remember, in our gross income discussion, we spoke about amounts that are received or accrued to the actual business in terms of income. So income is income if it's not capital in nature, and that's always something we need to consider. And the same thing applies when looking at a deduction. Right, when you have a deduction, you have deductions that are part of generating income. If you go look at study unit 5, I think I might even have a note here. No, I don't. It's in study unit 5. I'll just mention it here. In study unit 5, if you look at the general deduction formula, which is section 11A, okay, general deduction formula, I'm just abbreviating. Okay, the word deduction means to subtract or to minus or to take out. So if I'm looking at the general deduction formula, just to summarize the concept, if I'm generating income, so let's say you are running a business, okay, Marley's the business, and they are buying and selling products, and they are also paying for operational costs. right? And one of those operational costs could be something like rent. Okay, you need to rent a building, a factory, whatever it is. Let's just say it's the office. Okay, the head office needs to pay for rent. Right, if I'm looking at the general deduction formula, well, if you're paying rent, that would be seen as a payment that would be part of operations. Any payment that's in terms of operations could then meet the general deduction formula. So can I claim the rent as a deduction? Okay, because remember, you've got accounting here and then you've got SARS there. Right, so you've basically got the business and then you've got an external party. Right, so inside the business, when we work out profit, you take your income and you minus your expenses, and then that gives you your profit. And then your profit is obviously taxable. But now, when you look at SARS, you can't apply accounting rules. Okay, you have to apply tax rules, right? The legislation. So tax follows a separate system. And if I'm looking at SARS, then I'm going to look at income, but I'm going to look at gross income. I'm going to look at exempt income. I'm going to look at special inclusions. And then we don't say minus expenses, we say minus deductions, okay, and allowances. So the deductions is what we spoke about previously in study unit 5. If I'm looking at a deduction, I'm going to subtract those amounts from my income to get the taxable income. And that's basically what you're looking at here. Okay, what income do I need to pay taxes on? Right, so you've got two different systems. The one is accounting and the one is SARS. Right, and that's why you have these considerations in terms of rules. So if I'm looking at capital allowances, this word capital refers to assets. Right, so basically, if I buy an asset, let's say I buy machinery. Okay, if I'm going to buy machinery from an accounting point of view, that is not going to be seen as an expense. Okay, the machinery would be a non-current asset. If machinery is considered a non-current asset, it will be recorded in the balance sheet. Okay, you're not going to account for it in the income statement or the statement of comprehensive income. But if I'm looking at machinery, what do accountants process? Well, as an expense, there's an expense called depreciation. And if I look at this from an accounting point of view, you will see that depreciation obviously reduces the profit. If I have more depreciation, I'm going to have less profit. Right, so the same thing happens here in terms of SARS. So when looking at study unit 6, okay, the most important bit just to identify here is you need to distinguish between what is capital, okay, and what is not. So in other words, what is a asset, okay, in terms of your operation. So if I'm buying machinery, surely I'm going to use that machinery. Well, yes, if I'm operating. So when looking at a capital allowance, you're not going to be able to claim the cost of the machinery in terms of your purchase because that's buying machinery, that's not using it. So what SARS does, what the tax rules and laws say, is that included as part of this subtraction, I'm going to also include allowances. So it's deductions and allowances. And that's why you've got this slide here. Okay, so this is what I'm looking at in study unit 6. Okay, does that kind of make sense in terms of what a deduction is and how does that
Yes.
relate to an allowance?
Yes, it does.
Okay, perfect. Okay, so I'm just trying to recap some of the previous units' content just so that you've got an idea of how the system fits in. All right, so capital allowances are very specific and they're only specific to assets. That's the key. Right, so any asset that I'm going to be utilizing, right, in the production of income. Okay, so in other words, creating this line item, I'm going to be able to claim a portion of it or even all of it as a deduction, okay, but in the form of an allowance, not as a deduction as such. Okay, the word deduction relates more to income. Okay, just to clear the slide there, a deduction relates to income. So, in other words, daily operations. Okay, it's almost like that whole tree and fruit principle, right, where we spoke about, okay, the tree being capital and then the fruit being the income. Okay, and that's the principle that's applied in SARS, okay, from a tax point of view. SARS will distinguish what's capital, okay, and what's income because different rules apply. Right, if you're looking at something that's deemed to be income or is income, then you need to apply section or study unit 4. Okay, that's section in the Income Tax Act. If something is capital, right, depending on what it is, maybe you've bought an asset. If you've bought an asset, then you're looking at an allowance. Okay, if you've sold an asset, right, then you're looking at a disposal, then you're looking at CGT. Okay, that's a bit different. So that's the focus. The focus is always on this: capital or income, capital or income, capital or income. If it's capital, then you've got to follow certain rules. Okay, if it's expense related, so for example, I buy a machine, okay, while I use the machine, okay, the use is going to be accounted for in study unit 6. Okay, the depreciation is provided for as an allowance. Okay, it's not called depreciation, it's called wear and tear. Okay, and those are the different allowances that can come up in this chapter. Okay, wear and tear is the same thing as depreciation. Okay, but it's not depreciation because you have two different systems. You've got accounting and then you've got tax or SARS. Okay, the tax rules are separate from the accounting rules. In the accounting rules, we follow IFRS. When we look at tax rules, we follow the Income Tax Act. Okay, so you've got legislation governing how you account for um, different deductions or allowances in terms of a tax perspective, and then you've got IFRS, which determines and governs how you classify and represent income and expenses. Okay, so there's a very, very big distinction here in between. Okay, what's accounting is accounting, it's never tax. Okay, what's tax is tax, it's never accounting. But the only time where accountants provide for tax is if they look at something that's called deferred tax. But this is a little bit beyond the scope. Deferred tax will only be looked at in a further accounting module. So if you've done FAC the 300 series, the 3701 or 3702, whatever the numbers are, all right, then you would have done more advanced tax, and then this concept of deferred tax would have come up because that deferred tax provision basically comes from the timing or the differences between the two sets of rules. Okay, what is SARS accounting for versus what we're accounting for in terms of IFRS? Okay, we don't have to worry too much about that because in this module, all we're going to be focusing on is this, the tax rules. Okay, you're not going to have to worry about the accounting. Okay, I'm just trying to link it to the accounting because you know what depreciation is, so it's easy to understand that. Then we just need to apply it to tax. Okay, wear and tear is what SARS uses to distinguish, okay, the expense portion of the use of the asset. Okay, and that's what you're going to be using as a capital allowance. All right, and then the last bit is just calculations, right? So you do need to work out a scrapping allowance, a recoupment, and those are just profits or losses depending on whether you had a gain or a loss on the actual asset, okay, when disposing of it. Okay, so that'll be discussed later on, okay, when we look at a CGT type situation. Okay, so for now, we just need to consider these allowances and what these allowances actually mean in terms of the calculation. Okay, so the first part, there's the tree and fruit principle again. Okay, the big debate here, improvements versus repairs. Well, let me ask you, which one has an enduring benefit? Improvements or repairs?
I would say improvements.
Very good. Okay, so an improvement has an enduring benefit. This word enduring benefit comes from the distinction between capital and income. So this would be something that would be seen as capital in nature. And then if something is part of the production of income, the repairs would be part of that. Because if you think about repairs, repairs don't give any enduring benefit. A repair is part of operations. It's operational. So if it's part of operations, it's then considered income in nature. Right, so when looking at this concept, capitalization of expenses to assets, is it possible to capitalize? Right, the word capitalize means to add to the actual asset. So, in other words, am I improving the tree, okay, or am I just operating to keep the fruit? So, for example, let me use an example here. Let's say fertilizer. Okay, what would fertilizer be considered as? Would fertilizer be considered an improvement um, or let me use this capital or income?
Mm,
What would fertilizer be linked to?
I would say a repair.
Yes, good. The repair or the fruits. Good. So the income.
Mm,
All right.
yeah.
So if I'm using fertilizer, if I'm paying for fertilizer, obviously there's going to be an expense. Okay, so if I'm paying for fertilizer in order to nourish the soil, okay, so I can get healthier and more fruit, okay, that'll be seen as income. And then that'll be a Section 11A general deduction formula. But if I'm a farmer, okay, and I am producing lemons, okay, the fertilizer that I'm going to be purchasing, whatever I'm buying, okay, in terms of fertilizer would be an expense. That expense would fall under the general deduction formula. Right, so any fertilizer that's purchased in order to produce income, in other words, in order to produce the fruit, would be a general deduction. Okay, it would be part of the production. Okay, if you go look at the definition for the general deduction formula, they talk about carrying on a trade. Okay, so when I'm carrying on a trade, I'm actually conducting a business, I'm operating a business. So when looking at a farmer's business would be generating fruits. The fertilizer would be considered income. Okay, so if I'm looking at the tree, okay, in terms of the asset, am I improving the actual asset or am I just producing income? Well, fertilizer would be part of the producing income, not giving an enduring benefit. Okay, because once that fertilizer is absorbed into the tree, okay, and obviously into the fruits, right, it's gone. There's no enduring benefits, right? And this is what SARS uses to distinguish what is capital and what is income. Okay, SARS wants to know, is there an enduring benefit? Okay, so do you have the fertilizer for a prolonged or a indefinite period of time? In other words, do you actually like have the fertilizer? Is there an enduring benefit? Well, no, the fertilizer gets used up, right? There's no enduring benefit, right? So am I improving the tree versus am I using something to produce income or to operate, right? So what am I looking at here in terms of capital? I'm looking at expenses that would be capitalized to assets. So for example, I can't really apply to a tree unless maybe let's see, could there be an improvement to a tree? No, I can't think of one. That probably wouldn't work. But let's say a vehicle. Okay, so to link this example to the fertilizer, okay, fuel. Fuel would be similar to fertilizer. It's used within the vehicle. Okay, so here I had a tree. Okay, the tree would be the same as the vehicle. Okay, in terms of linking the two together. Right, the tree and the vehicle are both seen as capital in nature. The fertilizer would be similar to the fuel. Right, what's used up in the vehicle. Right, so if I'm focusing on the vehicle, an improvement to the vehicle could be maybe a new sound system. Okay, maybe a new tires, new mags. Maybe bulletproof windows or I don't know, tinted windows or whatever the case might be, right? Or spoilers or whatever. But the point is, the vehicle is the asset. If you are actually improving the vehicle, meaning, okay, the CD player, the sound system, the mags, those items are attached to the actual inverted commas tree, okay, to the vehicle, all right, and that defines it as being capital, right? So certain expenses, okay, when we look at expenses, meaning things that we pay. So when we look at accounting or finance, we talk about capex, okay, capital expenditure, and then we talk about revenue expenditure. Okay, revenue expenditure relates to operations. Capital expenditure relates to assets. Okay, so capex would be buying more machinery. Okay, capex would be expanding the factory. That would be capex. If it's revenue expenditure, that would just be ongoing. Okay, paying for the insurance, paying for the rent, paying for the water and lights, the ongoing costs of running or producing income. Okay, and that's the distinction that we need to make, right? And it's very important that you make that distinction because sometimes they give you theory questions and then you need to be able to discuss the merits of the case, right? They'll give you a scenario and then you need to go through the scenario and decide, is this capital or is this revenue? Should I be able to claim this as a deduction or shouldn't I? That's something to consider. Right, does that make sense? Is that okay?
Y- Yes, it is.
Okay, perfect. Right, so just to highlight those concepts, when looking at the system, okay, what do accountants use to follow statements? We spoke about it earlier. Do you remember what they use?
IFRS.
Perfect. Okay, IFRS. Right, what system does SARS apply when preparing inverted commas statements? Okay, remember their statements would be the tax return.
Mm-hmm.
What do they use?
Um,
What system do they use when looking at your assessment?
is it e-filing?
No, e-filing would be the platform. Yeah, so the system would be, or the rules, I should say. Okay, I'm just using system loosely. Okay, so the system
Okay.
that accountants use would be the accounting system, and the rules would be IFRS. In this system, it would be a tax system, and the rules would be the Income Tax Act.
Oh, okay.
Okay, so the most important thing is just the word act. Okay, so in other words, legislation. Okay, so when looking at tax, okay, we're looking at the rules and laws regarding taxes, not accounting, not anything else, only the tax.
Mm-hmm.
So if I'm looking at VAT, then I need to focus on that specific part of the act. If I'm looking at income tax, I'm looking at income. If I'm looking at pay as you earn, that's something different, employees. If I'm looking at, I don't know, estate duty, transfer duty, import, export, it doesn't matter what I'm looking at. If it's tax related, I need to follow the legislation, right? And that's why you have SARS rules and practice notes and all of those considerations when approaching the system, okay, when determining your assessment, okay, your tax return. Right, so are the systems the same? Answer is obviously
Yeah.
no. Okay, they're very different. Right, but they're similar. And that's what we need to look at. Okay, similar because in accounting we have something called depreciation. Okay, in tax we have something called wear and tear allowances. Okay, are they the same? Well, in theory they're the same, okay, but they're similar because tax rules and laws follow a slightly different process. For example, when looking at depreciation, maybe from an accounting point of view, you might have 5 years as the depreciation. But from a tax point of view, in terms of wear and tear, it might only be 3 years or it might be longer. Okay, so are the systems the same? Definitely not. Right, so if I'm looking at a deduction, okay, we also spoke about this earlier, so let's see if you remember. What is a deduction? What does a deduction relate to?
Something that can be left out or
Good.
taken out.
Yes, taken out of your income, okay, when
Mhm.
determining taxable income.
Yes.
Right, so remember the whole point of this is to get TI, taxable income. Okay, income less deductions, right, gives you taxable income after you've got to the bottom of that format. Okay, what is an allowance? Do you remember?
Um,
Okay, the deduction related to operations, the allowance relates to what
mhm.
type of.
Capital.
There we go, yes, capital assets, capital nature, basically. Okay, so
Mm.
items that are capital in nature, which are generally assets. So any assets would have an allowance potentially, not always, but potentially. Right, and it's the same thing basically. So SARS says you can less deductions and allowances.
Allowances.
And that's what we're looking at here. So are they the same? Well, from a tax point of view, they are. Okay, both reduce taxable income.
Taxable income.
Okay, but the one relates to operations and the other relates to assets, capital in nature. Okay, things that don't have a deduction. Right, so when looking at the second line, okay, this one, less deductions and allowances. Right, there's two options. Okay, do I have revenue expenditure or do I have capital expenditure? Right, if I've got revenue expenditure, then I can apply the general deduction formula, section 11A, general deduction formula. Okay, because it's part of operations. Right, and that could be paying for rent, paying for water, paying for electricity, paying for stationery, etc., etc. Okay, it's operational in nature. Right, so will SARS allow you to claim that as a deduction? Yes, because it meets that, a deduction. Then, if I'm going to be buying assets and using assets to generate income, right? So the printer, okay, the vehicle, right? The PC, the computer, the laptop, the tablet, whatever, okay? The machinery, the equipment, any of that, right? All of that would be considered capital expenditure. Right, so what does SARS allow you to do? Well, they'll say you can claim an allowance. So, in other words, a portion of the capital expenditure can be written off as a deduction, inverted commas, against your income when determining that, your taxable income. All right, so both reduce taxable income. Right, so they're similar, but they're different because the one relates to operations and the other relates to capital expenditure or assets. Right, and the last question, yet just for consideration, what contributes to business growth and development, and what incentives do business have to grow? Any idea? Let's look at the first one. What contributes to growth and development? So, in other words, how does a business grow? What does a business need?
It needs sales,
Okay, that's operational. Before you can make more sales, what do I need?
capital.
Yes. Okay, we need more assets, we need more resources. Okay, we need more capital. And that's exactly what we're looking at here. So, do businesses have an incentive to grow? Well, if we just think about it, right, obviously businesses would want to grow. Would you agree with that?
Yes.
Okay, but let's assume that the business, okay, has purchased a truck, a vehicle, okay, a delivery vehicle. Okay, that delivery vehicle could be 20 years old. All right? If the vehicle is still functioning, all right, is there any incentive for the business to purchase a new vehicle to be more productive?
Yes.
What would the incentive be? What would the incentive be?
Um,
If you think about it from an
it
operational
would be
point of view,
to improve business.
yes. Okay, so you could say to improve operations in terms of efficiency, maybe. Right, this 20-year-old
Mm-hmm.
vehicle or machine, right, or equipment. Okay, a 20-year-old machine or equipment or vehicle might not be as efficient, right? So, is there an incentive to grow? Well, possibly. Businesses might want to upgrade their machinery so that they can be more productive, right? But that's not the only incentive, right? Another incentive would be this, an allowance, right? And that's why most companies often upgrade their systems, okay, IT systems, equipment, okay, maybe even buildings and machinery and that type of thing, right? So maybe you've even noticed it in your company, right? From time to time they buy new things. They either buy new assets in terms of equipment, furniture, maybe they upgrade the PCs, the laptops, the tablets. They buy things, and the reason why they do that is not only because it's going to help with operations, but it's also because they want to take advantage of SARS. There's a tax benefit, okay, for buying new equipment, right? And what is that benefit? It's what we're looking at here. It's called a capital allowance, right? And that's what we're looking at in this chapter, right? So just to highlight the differences, okay, in terms of what we've covered in Study Unit 5, right? This is a slide from Study Unit 5. I've just taken this particular slide because of that point. Okay, if you look at the general deduction formula, which is section 11A, they will not allow you to claim anything that is seen as being capital in nature. Okay, the general deduction formula covers everything but none of the capital in nature items. So, in other words, if I improve the building, if I improve the machine, if I improve the equipment, if I improve the furniture, whatever I do in terms of improvements will not be deductible in terms of section 11A because it falls outside of the rules. And remember, SARS are very strict, okay, when applying the rules. They don't question the rules, right? Because the rules are set by government. Okay, they don't have the power to change the rules. They only administer and carry out the rules. That's what they do. That's their purpose, administer. Right, so if I'm looking at a general deduction formula, right, I'm applying, okay, deductions according to operations. Right, if I have items that are not of capital in nature, then I can apply possible capital allowances. And why would you ever want to do that? Because of this, the benefits. Okay, no one wants to pay more taxes than they have to. Right, you have to pay your fair share, right? But if you can reduce your taxes as much as possible, as long as it's in line with the law, okay, SARS can't stop you from doing that. Right, as long as you're following the rules, you can pay as little taxes as possible, and that's perfectly acceptable. Right, there's nothing wrong with that. Right, but if you are, so they talk about this tax evasion, okay, and tax avoidance. Okay, evasion is bad. Okay, you'll go to prison for that, or you'll have to pay a big fine. Okay, tax avoidance is legal, so as long as it's in line with the rules. Okay, you can avoid paying more taxes. Right, and a simple example, just think about an individual. Okay, so you and as an individual, you probably contribute to a medical aid. Okay, you probably contribute to a pension or a retirement annuity or RA or a provident fund, whatever it is. Okay, and the only reason why you probably do that is not only to benefit you and your family, but it's also to take advantage of this, reducing your taxes. If you didn't contribute to medical, you're going to end up paying more taxes. If you didn't contribute to a pension, a retirement annuity, or a provident fund, you're going to end up paying more taxes. Right, not everybody has a medical, not everybody has a pension. Right, but some people do, and the reason why they do that is not only to plan for the future, but also to lessen the burden of tax. Right, to reduce your taxable liability, your taxable income basically. Right, and the same thing applies for a company. what can companies use to even end up paying for to end up paying less taxes? They can use this capital allowances. Okay, so this is a very, very important deduction for businesses because how does it help the business? Well, first incentive to purchase, okay, is to improve efficiency. Right, so it's a good idea to upgrade, to buy new equipment, to buy new vehicles, to buy new furniture, machinery, tools, equipment, whatever it is. Okay, the incentive is better operations. Okay, from an operational point of view, I'm going to improve my efficiency. Okay, that's business management, okay, or operations. Okay, we're not going to look at business management operations, right, but there are some benefits for doing that. Okay, what are we going to be looking at here? Well, tax. All right, so how can government incentivize the purchase and use of assets? Government can give special deductions. They're not called deductions. I'm referring it to as a deduction. Okay, it's called an allowance, a capital allowance, and that's what you're looking at here. Right, so if you can understand the why, this is the why. Right, so why does study unit 6 exist? Study unit 6 exists because of what we spoke about. Okay, assets that are purchased, that are used for running a business, can be deductible, okay, as an allowance. All right, and that is a benefit for businesses because businesses can take advantage of improved operational efficiency as well as certain taxable benefits that they derive, okay, for making those purchases. Right, and it's in the best interest of government because think about this. If government is going to buy, well, let me rephrase it. If government is going to allow businesses to buy more assets, what is that going to do? Well, it's not only going to increase their business in terms of size, in terms of operations, but surely if the business has better equipment, if the business has better assets, they can produce more income. Would you agree with that?
Yes, true.
Yes. Okay, so if government can incentivize businesses to grow, the growth of those businesses will lead to more taxes later on when those businesses generate more income. Okay,
Okay.
and that's the why. That's why we have this as part of the tax system. Okay, there's logic in the madness in terms of so sometimes businesses look at SARS quite negatively because they think, oh well, SARS is going to tax me for everything, but they don't understand that businesses can actually make use of certain benefits. This is a benefit that no one else can claim except for businesses. Right, businesses can claim this benefit so long as they meet the requirements and as long as they follow the rules. And that's something that they can take advantage of. Right, so when looking at this chapter, study unit 6, capital allowances applies to both movable and immovable assets. So land and buildings can even derive a capital allowance. And that's why you often see from time to time certain businesses either moving head offices or creating or building their own head offices. And they do that because of the tax incentive. Right, they do it because not only is it going to benefit them, because now we've got a nice big new head office, but we're also going to derive a huge benefit from a capital allowance point of view. Right, and you'll see that later on. We'll talk about buildings and what allowances you can actually claim for doing improvements, okay, or building buildings, okay, property, plant, and equipment, okay, all the different allowances that relate to it. Okay, so two different types of assets, movable and immovable. Both assets can have a capital allowance, but you get different types of capital allowances. It's very important to understand what the purpose is of the assets. Okay, so purpose, I mean, is it for production of income, okay, or other? And you also need to consider this, the ownership. Okay, the ownership needs to be with the business. No business can claim a capital allowance if they don't own the asset. So, for example, if you lease a building, okay, you can't claim the capital allowances on the building, right? You will be able to claim your lease as a general deduction, okay, in terms of section 11A. Right, so if I choose to rent an office space, the rent that I pay to the landlord as a business would be this, a general deduction. Okay, what happens if I choose to buy a building instead of renting one? Well, if I buy a building or an office, okay, then I won't have a general deduction because I'm not paying rent. Okay, you will have capital allowances. That's what you'll have. Right, so SARS tries to incentivize both. Okay, they're wanting to support businesses that can't afford to buy buildings and where they lease. And what incentive do they give them? General deduction. Study Unit 5, Section 11A. Okay, what incentive does SARS allow businesses to make use of if they're actually buying buildings? So if they've got the resources to purchase buildings or to build buildings, surely they should get a benefit, and they do. Okay, those are called capital allowances. All right. Okay, do you understand the why? Is the why clear?
Yes, I understand.
Okay, that's important. That's the most important thing that I needed to cover in terms of understanding. If you know what each chapter deals with, then it's very easy to apply. Okay, so the point, just to recap, capital allowances relates
Mm-hmm.
to assets that generate benefit, future benefit. Government will allow you certain inverted commas deductions in the form of an allowance that will allow you to claim a benefit from those assets that you've purchased. Okay, the trucks, the equipment, all of it. It can all be written off as an allowance. Right, so here are the different types of allowance that you can get. Right, this is a Section 12C allowance. Right, it's for movable assets. Okay, the word movable is important. Okay, this is that whole purpose. All right, so in terms of movable, if something is movable, those assets are movable. Okay, a vehicle would be movable. Right, anything that's movable is something that's not fixed in a specific location. So, for example, it can be moved from place to place. That would be considered movable. Right, so Section 12C is wear and tear allowances on new or used. Okay, and important though, it must be machinery in the process of manufacturing. That's very important. Okay, it's machinery and it's part of manufacturing. Right, so if I bought a vehicle, okay, would a vehicle be machinery? No, it wouldn't. Would a vehicle be in the process of manufacturing? No, it wouldn't. All right, so a vehicle wouldn't fall under this particular section, it'll fall under a separate section. Okay, it wouldn't be considered this. This is for a movable asset that's used in manufacturing. Okay, are these vehicles used in manufacturing? That you could maybe
Yes.
motivate, possibly. Right, again, it depends on this whole inverted commas process of manufacturing. Right, and it comes back to the whole SARS debate, okay, in terms of disputes. Sometimes you might say, well, this is part of manufacturing, and sometimes SARS will say no, it's not. It's not closely linked. It's something separate. It could be a consideration. That's always something that you will have to debate with SARS. Sometimes these things get taken to court, and then you've got to look at stuff from chapter 1, 2, and 3, okay, where they look at that whole process of submitting an objection, appealing it, etc., etc. Okay, we're not going to worry about that. We're just going to look at different scenarios. So, scenario number one, movable assets, process of manufacturing. I have two options, 4 years or 5 years. 4 years is applied for new or unused, 5 years is applied for used. All right, I also need to look at the date. Brought into use for the first time, meaning after 20, not 20, well, 2002. Okay, 2002. And 5 years for any date, it doesn't matter. Right, so how do you write it off? 40%, 20%, 20%, 20%. Right, notice that covers the 4 years. Right, if it's 20% per annum, that covers 5 years. Do you see that?
Mm-hmm.
Okay, so if I bought a machine, and let's say it's a bottling machine, let's say we're bottling wine, okay? I've bought a machine that's going to bottle wine for me, okay? That's part of the process of manufacturing. Let's assume the machine costs 2 million. right? Is this machine new? Yes, it is. Right, so what is SARS going to allow me to do? Well, obviously, we're in 2020. Okay, so I'm going to apply this.
Mm-hmm.
I'm going to apply an accelerated write off, okay, according to the 4 years, not the 5 years. Right, so what am I going to write off? 40% times 40%. Okay, so I'm going to take 40% of 2 million, which is how much? 800,000. And what is SARS going to allow me to do with that? Write it off. When? In the first year, in year one. Is that going to help the business? Of course. Right, the business is going to have taxable
Yes.
income, okay, that's going to be less 800,000. Do you see
Mm-hmm.
that?
Yeah,
Okay, and that's what we're looking at here. Right, so is that an incentive to buy a new machine? Of course. Right, and that's why
it
businesses
definitely
purchase
is.
new assets because those assets can derive certain benefits not only from an operational point of view, but not only are we going to spend less time bottling wine because now a machine can do it for us instead of people. Okay, so not only are we going to improve our efficiency, we're also going to get a massive tax benefit. Okay, and these are called tax write-offs. These are tax benefits that businesses make use of. And that's why now you know why businesses like buying assets. All right, they do it not only because of operations, they do it because of the tax incentives. Is that okay? Are we okay, Melanie?
Yes, I'm here.
Okay, perfect. Okay, so that was section 12C. Section 12E, what is this looking at? SBC allowances, okay? New and used. All right, so earlier we spoke about any type of business. Section 12C relates to any business. Section 12E relates to what? An SBC. What determines an SBC? Do you remember?
I think the taxable income or the turnover something turnover sales.
Well, not quite. Okay, that's a micro business. Remember, you get two different categories. A business can either be classified as a SBC or a micro business. If it's a micro business, then you're looking at
Mm-hmm.
turnover on sales. If it's an SBC, then you need to follow the criteria. Remember, there were 5 notes that we had to look at. One of it was a natural person. Another one was less than 20 million. Okay, just go back and look at the criteria. There's a table in one of
Okay.
your notes that highlights all of it. That's quite a nice one. I'm going to use the same table when I look at past papers and assignments and that. Um, that's what you need to
Okay.
look at, okay, in terms of SBC. Right, assuming we meet all the criteria for being an SBC. Okay, just look back at your previous notes just to cover that again. But I'm
Okay.
assuming we meet the definition of an SBC. Okay, so earlier we had an example. A bottling machine for wine costs 2 million. Okay, I am a special business, I'm an SBC, right? Is this asset part of manufacturing? Yes, it is. What does SARS give you as a deduction? Well, now I've got income and I'm going to less deductions and allowances. Okay, this allowance is going to be 2 million and then you'll get your taxable income. Do you see it?
Yeah.
Okay, so what is the benefit here? Well, that basically says whatever you purchased in that particular year, as long as you're an SBC, you're going to claim 100% back in terms of SARS.
Mm-hmm.
So basically, if you made income, let's say you made 2 million, let's say you sold wine amounting to 2 million. Okay, and then you've got this 2 million rand asset that you purchased. How much tax are you going to pay in that year? Zero, nothing. You'll keep that 2 million for yourself basically. Do you see the benefits?
Yeah. Yes.
Okay, and that's why capital allowances are so important. And they're only applicable for businesses. This doesn't apply to individuals, okay? It only applies to businesses. Okay, when I say a business, I'm referring to a sole proprietor, a partnership, a CC, a company. Okay, any business, right? And any business that meets the criteria in terms of an SBC will make use of this massive benefit. Section 12E says if it's manufacturing, claim all of it. If it's non-manufacturing, right, this is even a step further. Right, so earlier, okay, remember, non-SBCs can only claim machinery for manufacturing. We just looked at it, it's on this slide. Okay, if I'm an SBC, it even gets
Yeah.
better. Okay, if I buy stuff that I'm not even using for manufacturing, I can still claim 50% in the first year, 30% in the second year, and 20% in the third year. All right, so there are benefits for being classified as an SBC. And why does SARS give these benefits? Is because they want to help small businesses. Right, remember, SARS is Big Brother. If SARS can help those little SMEs, okay, those SMEs are going to grow and they're going to become big businesses. When they're big businesses, then SARS can tax them as much as they want. Okay, does that make sense?
Yes.
Okay, good. All right, so I've just put a note here regarding the SBC. Okay, it's even taxed lighter inverted commas because of this, the sliding scale. Okay, this we spoke about previously. This is a progressive system.
Yes.
The more I earn, the more I pay. Okay, who does this apply to? It applies to an SBC, small business corporation. Okay, small business corporations not only benefit from having to pay less taxes, okay, they also get this accelerated wear and tear allowances, and we just looked at it, section 12E allowances, deductions. Okay, the word accelerated means they can actually write it off quicker, and that's better. That benefits them because they don't have to pay more taxes in the early stages of their business. Okay, so I've just put a little note here. If section 12C, so in other words, if the SBC is this one and the normal is that one. Okay, so if I've bought an asset, okay, and I've been able to claim a capital allowance. So, for example, I'm going to go back to the 2 million rand bottling machine that I spoke about. Okay, business number one, normal. Okay, how are they going to write off the new asset? Well, if it's new, I'm going to write it off 40. Okay, 20, 20, 20. Remember
2020.
that?
Yes.
Okay, so if I'm writing off 40% in the first year, then 20, 20, 20 in the later years, okay,
Mm-hmm.
obviously I'm going to get to a stage where I've written off everything. I've written off the whole 2 million. Does that make sense?
Yes.
Okay, if it's an SBC, it's even better. If it's a bottling machine, if it's a new machine, well, the SBC is going to write off 100%.
100%.
Okay, once a new asset, or once any asset, it doesn't have to be new, it can even be used. Once that asset has been written off, so when I say written off, inverted commas, I mean claimed as either a deduction or an allowance from a SARS perspective. You cannot claim wear and tear. Okay, so wear and tear only applies to assets that you haven't written off already. Okay, because if I've written off the 2 million, I can't claim wear and tear. Because what is wear and tear? Wear and tear is basically similar to depreciation, but depreciation from a tax point of view. Does that make sense?
Yes.
Okay, so this applies. Okay, this annexure does get updated. This was an annexure that I had downloaded from the SARS website in terms of interpretation notes. I'm not too sure if it has changed or not. I haven't looked at that for quite some time. It might or might not have to. Okay, you can just Google it. You can literally just
I'll
Google,
check.
yeah, the different allowances. Okay, I don't think it has changed, but I could be wrong. I haven't seen any updated communication regarding this. Right, it's probably the same. And what does this provide you with? Well, write-offs in terms of periods. Right. So when does this apply? This applies for other assets. Okay, other assets. When I talk about other assets, I'm referring to assets that you haven't taken advantage of in terms of a capital allowance. You haven't applied section 12C or section 12E. Right, then can I claim wear and tear? Yes, you can. Right, and this is something that all businesses can also make use of. As long as you're providing a service or a product and you're running a business, you can claim certain wear and tear allowances on those assets that you've purchased. Right, I haven't given the complete table here, I've just given some. Okay, is that all right? Are you comfortable with the movable
Yes.
assets?
Yes.
Okay, perfect. Okay, so now forget about the movable assets for a minute or two. Okay, now we're changing focus. Right, so those slides that you just saw earlier refer to movable assets. Okay, so when I look at test questions or assignment questions, I need to make that distinction. Okay, I have assets that are movable and I have assets that are immovable. In this section, okay, this slide and the ones that come after this, I'm focusing on immovable assets. Immovable means things that are fixed, that cannot change location. Okay, so buildings are immovable. Right, so can I derive a capital allowance from a building? Well, the answer is yes, you can. Okay, you have a section 13(1) deduction, you have a section 13 quin deduction, and you have a section 13 sex deduction. Okay, those are the three different deductions specifically for immovable assets focusing on buildings. Right, so the first one, section 13(1), a building only deduction. Building only means, okay, not the land, just the building. So, in other words, what's occupying the space on the land, the fixed, the immovable asset, the actual construction. Okay, the buildings. Okay, the buildings on the property will have a deduction. Okay, what is the deduction? Well, if the building is used mainly for manufacturing, right, so if this is a factory, okay, what are factories used for? Manufacturing, obviously. Right,
Manufacturing.
so if it's mainly used for manufacturing, what can I claim? I can claim 5% as an annual allowance. So if the building is worth 100 million, 5 million is going to be claimed as a building section 13(1) deduction that I'm going to claim as a taxable not a taxable, as a deduction, okay, to reduce my taxable income. Does that make sense?
Yes.
Okay. It gets better. Right. It doesn't only have to be manufacturing buildings, it can also be commercial. Right. Commercial could be something like a head office. Right. You're not going to be manufacturing stuff at the head office. Okay. The head office is more the
No.
admin, okay, the management and so on. Right. If it's a commercial building, right, it must be used for the purposes of a trade. So in other words, in the production of income. And that's quite easy to motivate. Okay, we can obviously motivate why a head office would be used as in production of income. Okay, decision making, the nexus, the point of not nexus, the economic nexus. That's what they called it. Okay, remember we spoke about resident versus non-resident. That's a previous chapter. That's also something to
Yes.
revisit. Okay, when looking at the location. All right, so this is something important in terms of commercial building. Commercial, same thing, 5% per annum, but it's not apportioned. Okay, not apportioned meaning it's just 5%. Okay, and obviously the date post April 20, 2007. Okay, so remember these are things that have come in recently. The reason why you have these dates is because that was when the new amendments to the law took effect. Okay, so remember SARS can update and change the rule of law. Okay, we spoke about this in chapter 1, I think it was. Okay, where we spoke about
Yes.
parliament and passing laws and rules and so on, and then SARS applying them. Remember that?
Yes.
Okay, so this is just looking at when those rules and laws actually apply. So from that date onwards, okay, commercial buildings will allow, okay, for a 5% deduction. Right, and then the same thing can apply for residential units, but again, only after 2008. Right, and the same deduction applies. It's 5%. It's 5%, 5%, 5%. We just need to remember what type of building is it. Okay, is it manufacturing, is it commercial, or is it residential? And then we need to remember the dates. Sometimes those questions in the past paper will give you a date. And the reason for that is you might have bought a building, okay, prior to 2007. But are you still operating in 2020? Yes, you are. All right, so can you still claim a deduction in 2020? Well, possibly. Okay, depending on when you had bought the building. Does that make sense?
Yes.
Yeah, so the date is important, and we'll see questions covering that. All right, there's two other ones here to consider, and these are looking more at development type companies. Okay, low cost housing, urban development. Right, so section 13 sept, okay, and quats. Right, those two regard or are with regard to more development type situations. All right, so if I'm a developer, okay, or if I'm improving the land, or if I'm basically producing immovable assets, okay, or creating immovable assets, you could also derive a benefit. Low cost housing units, okay, 10% of the amount owing. Okay, this is the loan account that's used in order to construct those residential units. Okay, there could be a deduction that can be claimed as a capital allowance, 10%. Right, that's obviously going to help the developer. Okay, and that's why you see developers producing all of these residential units, and they're doing such a lot of it all over the place. Okay, I'm not too sure what developments are happening in Durban, KZN. Okay, you'll probably know better than I will. Okay, but I'm sure you've seen some new developments in KZN. Maybe close to the, what do they call it? The uh, um,
Gateway.
yes, Gateway. Yes. I'm just trying to think of that strip. What do they call that strip in Cape? Not Cape Town, in Durban, by the beach, where Moyo is on that, like the harbor thing. What do they call that? The
Um,
mile? What mile is it called?
uh, I forget now.
It's something miles. I don't know what it's called, but I don't know in Durban. It's where all the
Mm-hmm.
tourists go. It's like along the beach. Do you know what I'm referring to?
No, no, no.
It's in Durban. I'm just trying to think of it. Where the casino is, and Ushaka
Talking
Marine
about
World.
Sabaya.
Is that what it's called?
Or are you talking about Suncoast?
Suncoast? Yeah, the casino. Near the casino, there's like
Yeah.
where the
Yeah.
beach is on, where Moyo is and stuff. I don't know what that
Um,
strip is called.
i- the new promenade.
It could be. Promenade sounds
Yeah.
similar, but I think it's about a mile or so. It's quite a long distance, and they've improved it, like they've developed it and stuff. They've made it
Yeah.
nice for
They have.
tourists.
Mm-hmm.
Yeah, so I'm just trying to refer to that in terms of like this development. Okay, so this development obviously developers spend a lot of money. It could be government, but it could also be private, right? And maybe you know of housing projects that are being created. Okay, low cost residential units or urban development zones. Okay, refurbishments, right? So maybe you had an old hotel. Okay, let's say you had an old hotel somewhere in Durban, and now they've refurbished it, they've upgraded it, they've improved it. Right? Is it possible to claim a deduction for that? Well, yes. If it's new in terms of extensions, new or extensions, okay, you can claim 20% in the first year and then 8% for the next 10 years. Right, that's for urban development, for refurbishments. Right, refurbishments
Okay.
20%, new or extensions 20%, and then 8% every year for 10 years. Right, is that okay?
Yes.
All right, perfect. Okay, and then just the last note here, just to wrap up this section. Okay, next time we're going to look at the capital gains tax. Okay, we're going to speak about that. All right, so we've spoken about capital allowances. They relate to assets that are used. That's important, not sold. Okay, if an
Mm-hmm.
asset is sold, then we will have a disposal. And when we have a disposal, okay, remember we spoke about all these capital allowances? What do those allowances
Yes.
do?
To give you a tax relief.
Yes, they reduce the taxable
Your
income.
tax.
Agree?
Yes.
Okay, so when you sell a building, okay, if you sell an asset, if you sell machinery, okay, if you sell equipment, if you sell a building, whatever it is, right, what do you have to work out? Well, from an accounting point of view, okay, think about accounting. You would have done this in one of your previous modules, okay? When you
Yes.
look at the profit or loss on the sale, okay, i.e., the disposal, right, you're either going to have a profit or a loss that you need to account for in the accounting records as part of your statement of comprehensive income. Okay, it'll be a profit on sale or a loss on sale, and it's part of operations. Okay, and that obviously affects the profit or the loss for the year. Do you agree?
Yes.
Okay, the same thing applies in SARS, in tax. Okay, so that's why I've tried to show this distinction. Okay, keep it separate. What's accounting is accounting. What is tax is tax. Okay, when we look at tax, SARS doesn't call it a profit or a loss on sale. SARS talks about a recoupment or a scrapping allowance. That's what they talk about. And if you can remember back to income, when we spoke about income, we said there is a special inclusion. Okay, a special inclusion, recoupment. A recoupment needs to be included as part of your income because it's a special inclusion. Right, and now we've discussed what it is. A recoupment is when you make a profit on the disposal of a capital asset. In other words, when the proceeds are greater than the TV. The TV stands for taxable value or tax value. Okay, another word for that could be base costs. Okay, SARS will have a view on your asset, the base cost or the tax value. Right, what is the taxable value of that asset? The taxable value of that asset would basically be the same as the carrying value. Right, so when you look at accounting, you talk about carrying value. When you look at SARS, you talk about tax value. Okay, what
Tax
would the tax
value.
value be? The tax value would be the cost of the asset less any allowances. They could be capital allowances or they could be deductions in terms of wear and tear. It doesn't matter. Okay? It's cost minus deductions or allowances gives you the tax value. Right, that tax value needs to be compared to the proceeds. If the proceeds exceed the tax value, you'll have a recoupment. If the proceeds are less than the tax value, you'll have a scrapping allowance. And the scrapping allowance, okay, is a special deduction. Okay, something else we saw in a separate note. Okay, special deductions. Okay, so it doesn't meet the general deduction formula, but it's a special deduction, and I can claim it. Right, there's just a note here. In terms of SARS, the recoupment is always limited to the previous allowances. Right, so when I say limited, I'm referring to the amount, okay, the value. Right, the value of the recoupment. In other words, what is included as a profit. So, for example, if I've made a massive profit on the sale of an old asset, okay, SARS will only recoup, okay, what they've provided for in terms of the previous allowances, and that's just part of the rules. All right, they don't allow you, or they don't include more than that. Why don't they include more of it? Well, the additional would be what? Any idea?
No idea.
Okay, the additional above the capital allowance would be a capital gain, CGT, and that's the next chapter. Okay, so SARS will only
Okay.
allow for a recoupment up until the amount that was given as allowance. Anything that's above that, okay, would be viewed as a capital gain, and that'll be covered in the next unit, study unit 7. Right, and that's why you need to know when everything applies. Right, a recoupment applies to the operational aspects of the business, the profit or loss from the sale. Okay, and that will be recouped up until the allowances. Anything above that is seen as a capital gain. And that's next time's content. Okay, does that make sense?
Okay. Yes, it does.
Perfect. Right, then I've just ended here just with some notes just to consider the differences accounting versus SARS. If the disposal proceeds, okay, of the building is used to buy building Y, then there is a deferral of the recoupment. Okay, what does the word deferral mean? Do you know?
No idea.
To defer is to basically to put it later or to delay. Maybe the word delay is a good synonym.
Yeah.
Okay, to delay the recoupment of the allowance. Right, so if you're using a disposal of building X to buy building B, well, obviously, if I'm disposing of building X, I'm going to have a possible recoupment. And if that recoupment comes up, okay, I can defer that recoupment because I'm buying a new building. Right, the recoupment is set off the new building. Right, and that's just something that SARS can help with in terms of not making it more onerous on the business in terms of operating and not meeting the obligations. Right, because what does a recoupment do? Well, a recoupment is a special inclusion that's going to increase the taxable income. So, in other words, if you have a recoupment, you're actually going to end up paying more taxes instead of less taxes. Okay. But the new building, okay, just a little note, must be purchased or built within 12 months. All right, so you can't claim a deferral of a recoupment on a building that was used to purchase another building, but it was done long ago. That wouldn't make any sense, and SARS doesn't allow that. Okay, they are very
Okay.
strict. I don't think I've seen any questions covering this, but it could come up. I mean, it's something that was or is discussed in your study guide, so it could be examinable. It could be examinable depending on the examiner. Okay.
Okay.
All right. Then just to sum up, I've just put this slide just to show the differences. Okay, I'm going to see if you can remember some of it. Okay, obviously you've covered it now. It might be new, but let's just see what you can remember. Okay, immovable or movable. All right, is there a difference?
Yes, there is.
What's the difference?
Movable is like your machinery, immovable is like your buildings.
Perfect, good. All right, when looking at a capital allowance, do we need to distinguish between the two?
Yes.
Yes, we do. Okay, second thing. With capital allowances, do we need to know if it's part of manufacturing or not? Is that important?
Yes, it is important.
Why? Why is it important?
Because different sections apply.
Correct. Okay, section 12C, there's the answer, manufacturing. This is for a normal business.
Mm-hmm.
Okay, section 12E, special, SBC. Okay, there's SBC. I actually wrote it again, but anyway,
Yes.
it's fine. Right? It's SBC, it's special. Right, and that's for manufacturing and non-manufacturing. It doesn't matter. Right, so is it important to distinguish between the two? Definitely. Right,
Yes.
it doesn't apply for section 12C, it does apply for section 12E. Does that make sense?
Yes.
Okay. Do we need to distinguish between SBC or not? That's an easy question.
Yes, we have to.
Yes, because now you could get an accelerated
Allowance.
allowance or not, depending on what you are. Does it make sense?
Yes.
All right, and then the last bit is here, it's just a portion or not. A portion means part of the year.
A part of.
It's the same as accounting. Part of the year. If it's not apportioned, it doesn't matter. It can be 1 month from the year end, okay, or it could be at the beginning of the year. It makes the difference. If it's not apportioned, you claim the full amount. All right, and then section 11E is for other movable assets. That's wear and tear. Okay, another word for wear and tear in terms of accounting, depreciation.
This.
Right, section 13 covers all these building allowances. Right, so in section C, you've got 4 that you need to look out for. I'm looking for normal, I'm looking for SPC, I'm looking for other, and I'm looking for building. All right, those are the different assets that you could be given. And then I need to know which deductions or allowances to apply. Okay, happy?
Okay. Yes.
All right, so this summarizes the different deductions, right? And then I've got separate notes covering each one of them. So when we look at past papers and tests and exams and assignments, we'll do the exact same thing. Okay, we'll look at, well, what am I dealing with? Is this an asset? That's the first question. If it's an asset, then I need to ask all these other questions. Is it movable? Is it immovable? Is it manufacturing or isn't it? Is it SPC or isn't it? And then must I apportion or not? That's what I need to do when I look at a question. All right. Happy, Melanie?
Yeah. Yes, I am.
Perfect.